cracking then on trading hour right now. We're now joining and talking about the box office collections. Now, shares of PVR have hit a fresh 52-week high following the release of Shah Rukh Khan's Jawan, which is expected to clock in record collections. This follows hits like Jailer, Gaddar 2, OMG 2, which have also seen good box office collections. And not to forget, in the month of August, we also had a few good Hollywood releases, whether it's Barbie, Oppenheimer, Mission Impossible. All in all, Q2 is turning out to be a blockbuster quarter for PVR Inox. To take this forward, we're joined by Karan Tarani from Elara Capital. Karan, morning, and thanks so much for joining in. Now, PVR Inox has already reacted, it appears, to this, because in the last few months, in 3 months, in fact, the stock has moved up nearly 30%. So, in a way, it's expecting strong numbers from PVR Inox. So, do you think the good news is in the price? That's question one. And two, is this recovery in box office collection a cyclical or a structural thing? Because if it's cyclical, then if the content is poor, once again, we're going to see consumers shun, going to the theaters. Or is this a bit of a structural trend that even if the releases are average, you could continue to see footfalls into the theaters?
Hi, Rima. Good morning. Pleasure to be here. If you look at the first question, in terms of the share price movement over the last 3 months, as you pointed out, obviously a lot of positive is already priced in right now. We were expecting, occupancy levels to kind of move up more closer towards pre-COVID levels in this quarter. But I think, what has happened is that this is kind of surpassed our expectations. Potentially, if Jawan emerges to be a blockbuster, you could see a scenario wherein occupancy levels are above pre-COVID levels and not only towards pre-COVID levels. So that is a very big sign of respite, and that could lead to a further upgrade. We can't forget the fact that it's a very high operating leverage business. So even 1% change in occupancy has a big positive impact on EBITDA, about 80 to 90 crores in our view. So broadly, I think a large part is priced in, but I think there is still some juice or momentum left. If Jawan emerges to be a blockbuster, which seems to be, a high likelihood event right now. To your second question, particularly, around the cyclical trend and whether this is sustainable, I think one good thing is that, Hindi content has kind of changed in terms of the nature of content. We are now seeing films which are VFX driven. We are seeing films which are franchise driven. We are seeing films which are original content and not remakes of South and English films. So because of this, there has been a respite in Hindi content. And as you clearly know, Hindi content is the one which drives profitability. So this quarter, you not only have good occupancy, but you also have good profitability. Because in the case of Jawan, in the Jan-Feb-March quarter, you saw EBITDA margins being very low as compared to pre-COVID levels. So given the synergies in the merged co, you'll also see EBITDA margins probably being beyond pre-COVID levels in line with occupancy. Now, whether this trend is sustainable or not, I think that is a question mark, because what has happened clearly is that fortunately, all the large budget films are doing well. Small, medium budget content remains to be a laggard. So you might see a volatile movement here, in terms of some months box office is good because large budget films do well. But unless small, medium budget Hindi content doesn't come back, I think this trend is going to be kind of volatile.
I think, and we have to keep tracking this volatility to see what happens. And the quality of content will be that one variable that really, investors can do nothing about. Karan, let's talk, in terms of some numbers. I believe occupancy for PVR would be now, closer to around the 30% mark. Tell us the latest numbers that you have. And how does that compare with average occupancies pre-COVID? And the same number for valuations. Let's talk valuations today versus peak valuations before the crisis. What are we looking at?
So I think if you look at broader occupancy numbers, I think, Q1 in terms of occupancy, Q1 FY24 was around 22%. This month, the kind of momentum we have seen with, Hollywood in the month of July and Gaddar 2, Oh My God 2, Rocky Rani Prem Kahani, and also Jawan in September. I think occupancy levels could move, beyond pre-COVID levels. So pre-COVID level occupancy for the merged co was around 32%. We may obviously get closer toward that, so I will breach that depending on the performance in the month of September. As far as valuations are concerned, I think from a valuation standpoint, since the small, medium budget content is not coming back, we don't foresee that they will trade at those peak valuations. So if you look at, both these companies, when they were listed separately in the pre-COVID times, the average multiple for PVR was around 13, 14 times forward EV/EBITDA at a time where content was doing well. Consistency of films was doing well. Number of films were higher as compared to what it is today. It's come down right now. And you also had small, medium budget content clicking that time. So the peak EV/EBITDA multiples that time around was 14 times forward. But now if you look at the merged co, I think given the synergies in place, potentially this number can become 16 and a half times because of the synergies between the merged co. But because the content is volatile, I think, on a peak valuation multiple basis, these companies will currently trade at 13 and a half to 14 times forward EV/EBITDA, factoring the synergies and the merged co. But if the content consistency improves, if small, medium budget content comes back on a structural basis, you could see a re-rating on these valuation multiples also.
I'm surprised to learn that the pre-COVID occupancy was 32% only. I would have suspected, it's a lot higher, Karan. But okay, that's about PVR Inox. Let's move on to talking about Nykaa. Now, current Tira, which is the BPC, the beauty and product segment, which is launched by Reliance Retail, has made a big splash. The app was launched in April, but earlier, I think last week, Tira had a big in-person ground launch. They've signed on brand ambassadors in the form of Kareena Kapoor, Kiara Advani, and Suhana Khan. The app, I was checking, it's offering far more discount compared to Nykaa. I think you're getting about a 15-20% kind of a discount. How would you assess the competitive intensity on account of Tira, and what impact will it have on Nykaa?
So as far as Tira is concerned, I think, as you pointed out, they launched in the month of April. I think they haven't done too much in terms of potential market share gain on ground, as per our primary checks. And broadly, I think obviously, they just started off. They're going to, change things, rejig things, and maybe they make a big comeback in the market. But right now we don't foresee any Nykaa, Tira being a big threat, because we believe this BPC category is very large. It's only about 10% penetrated as far as online is concerned. And we have seen other players also try out BPC. We've seen, Myntra, Amazon, Flipkart are already doing a lot of BPC. We have seen even MyGlam, Purple kind of platform, seen Big Basket trying it. But what Nykaa has here in terms of clout is clearly product genuineness, a very high AOV as compared to peers. If you look at Nykaa, their AOV is about 2.5 times as compared to the industry average, which goes to show that they have a very strong recall with the premium customer base. And this premium customer base, looks for, product genuineness and doesn't necessarily looks for discount. So I'm not saying that, Tira, might not be big. Tira obviously also can scale up in a very big way, but it's going to take some time because this business is all about, owning the customer and knowing your customer. And you can't forget the fact that Nykaa has got a first move advantage. They've done really good work on content, influencer marketing, everything put together. So Tira obviously has to replicate that, but execution is the challenge.
No, fair enough, but will anyone doubt product genuineness from a brand from Reliance Retail, Tira? That was the mode, right, for Nykaa. Is anyone going to doubt that? And secondly, if you could tell us what were the growth numbers that you're estimating? Now, BPC's, that's Beauty Personal Care segment, GMV growth was 33% in FY23. What would the number, according to you, stand in FY24, FY25?
Right. So I don't foresee anyone doubting Tira in terms of product genuineness, but it is just about, getting to know the customer. A lot of work needs to be done in terms of penetration, reaching the right number of PIN codes, doing a lot of work in terms of logistics, warehousing, everything put together. So Tira will definitely get there, but it's going to take some time. And as I said, this category is quite large. So there is a potential for, 3 or 4 players to coexist in this market. And I don't see discounting driving customers from one platform to the other, as I said, because the customers are premium in nature. Now, to your point in terms of the broader growth rates, I think if you look at the online BPC market as such, it continues to grow at about 26-27%. And the estimate is that for the next 3 years, this will be the number on a CAGR basis. If you look at Nykaa numbers broadly, I think in Q1, they reported around 23% growth in the BPC GMV. I think with the festive season in the Q3 and, momentum picking up in H2, you could see these growth rates increasing. But our numbers are around 25% for the Nykaa BPC GMV, which is as per our estimates. And we believe clearly that, unless these numbers don't go haywire, like, they don't go towards 20% or below 20% because of competitive intensity, we don't foresee a big threat for Nykaa in terms of valuations.
Yeah, but Karan, some will argue that the numbers are fine, but this listing has probably been one of the most disappointing listings of the past 1.5, 2 years, right? It was a profitable company when it came to the market, unlike a lot of its peers. And yet, 400, and where are we now? Is struggling at around 150. Has really destroyed a lot of value. Do you see a turnaround? Now, I'm not asking you a next 2 months or 3 months question. If someone's still holding on to Nykaa shares today, should they have reason to hope? Conversely, would you advise buying at the moment at all? And what's your target price in Nykaa?
So two things here, I think, one from a risk reward standpoint, if you look at most of these new age companies, they have rallied a lot over the last 6 months, and valuations somewhere are at reasonable levels as compared to Nykaa, where valuations are still, kind of lower. And the reason for that is very clear. I think one is this threat of competition, which everybody foresees, and people are actually trying to build in numbers of maybe 20% or below over the medium term, which could potentially have a negative impact on valuation. And second negative reason is the fashion business. I think the losses therein haven't kind of come down, and fashion, they really have no moat or recall as such. They are trying to focus on the premium fashion business, but the fashion market at large is really big. So I think concerns persist, but from a risk reward standpoint, if you see a potential turnaround of fashion losses coming down, and if you see a sustenance on Nykaa BPC growth rate, I think you could see a share price performance, over the next 6 to 12 months. And this could sustain from medium to long-term standpoint, because the company does not have any concern in terms of profitability. So if you look at other new age companies, they've struggled to get profitability. They're now getting profitability. But if you look at a company like Nykaa, they've been profitable since quite some time. So I think from that standpoint, Nykaa is like a preferred pick at these valuations.
Preferred pick. Thank you very much, Karan, for joining in. The dynamics, constantly changing in this particular market. Get into a break. We'll come back.